Here to talk a little bit about the wealth management industry and our day in the life. So we'd love to make this as interactive as possible, so feel free to jump in and ask us any questions. We'd love for you to get as much out of this as possible. So yeah. So with that, we did put some slides together. So just as a overview, as a day in the life. But yeah, feel free to jump in at any time. So just by way of introduction and background, so my name is Chris Young. I'm with Wells Fargo Wealth Management. So I've been in the investment industry for about 13 years. I graduated from the University of Minnesota Duluth back in 2006, where I was part of their financial markets program, so their student managed fund. From 2006 until 2010, I was in New York working for AIG Investments. So I had started in private equity. So our group was doing due diligence on private equity fund managers. So was there for a couple years and then moved into their equity group. So we had a high dividend equity income fund that we were managing assets for the insurance company and also for some third-party clients. So 2010, I went back to get my MBA from the University of Michigan. So after graduation in 2012, I moved back here to Minnesota, where I'm originally from, joined U.S. Bank in their wealth management group. And then 4 years ago, moved over to Wells. So we'll get into that in a little bit more detail, but basically we're working with affluent and high net worth clients and really helping them uncover what their goals are and then helping them put a plan in place in order to meet their goals. But with that, I'll turn it over to Jacob.
Yeah, thanks, Chris. I'm Jacob Rice, and I've been in the industry for about 4.5 years. I went to Carleton College, a small liberal arts school down in Northfield, Minnesota, and I studied psychology there, graduated in 2014. Obviously, I'm not doing psychology right now, although there's plenty of psychology involved in working with clients and in the market, and handling with markets and investments and whatnot. So a little bit about my path. When I was, approaching graduation, I was really exploring the next steps in psychology. And a lot of them involved master's programs, PhD programs. I wasn't particularly interested in that. And some of the professional options that were available, I don't know, didn't really tickle my fancy either. So I had taken a number of economics courses when I was at Carleton. I considered becoming an econ major. And I thought I would chart a different path and go into the world of financial services. And so I started with Ameriprise Financial then in 2014. I was in their alternative investments group. And that was a good experience. It was a great way to sort of immerse myself in a large financial institution, learn about markets and economics and things of that nature. It's such a big company that I was able to network extensively and talk to people on all sorts of different teams and groups and really get a feel for the industry. Ultimately, though, after about 2 years, I felt that I was really just focused on Ameriprise's suite of alternative products, and I wanted to branch out. I wanted to learn more about other asset classes, portfolio management, strategy, things of that nature. So that's when I opened up my search and sort of ended up getting hired by Abbot Downing, where I've been ever since. I've been at Abbot Downing now for 2.5 years, and I'll sort of launch more into about the firm, maybe the next slide or so, but we talk about, so we both work for WIM, or Wells Fargo Wealth and Investment Management. You can see there's sort of 6 groups that comprise WIM. And I work for Abbot Downing, so we focus on ultra-high net worth families, individuals, family offices, and then foundations and endowments. So ultra-high net worth, we're targeting clients with investable assets of $50 million and up, and net worth typically $100 million and up. Very unique level of wealth, certainly. The firm, we have over 300 professionals working in 11 formal offices across the United States. About $45 billion in assets under management currently. I think of the last official marketing figure I saw. And I think that's Abbot Downing in a nutshell. But I would say our focus is we're trying to provide a comprehensive suite of products that's manages families or individuals or foundations sort of total wealth management experience. So obviously, I'm on the asset management team, so I'm charged with creating investment portfolios and managing those portfolios, and that's a very important component. But we also have private bankers who are there to meet the client's credit needs. We have wealth planners who are there to help with the planning aspects. We have trust services and administrative services, fiduciary services. Since we work with so many families and often like multi-generational families, we do provide a lot of services that deal with family dynamics and family legacy and things of that nature. And so ultimately our approach, we have a relationship manager who sort of is like the center of the center of a wheel, and each of those arms is kind of a spoke, and we work together as an integrated team to provide help the clients meet all their financial goals and needs. So
yeah, and I'm in the wealth management group, so that encompasses both wealth management and the private bank. So as I mentioned, we're really more we're in the affluent in the high net worth space. And similar to Abbot Downing, we very much have a team approach. So our goal really is to help clients build, manage, and ultimately, in many cases, transition their wealth. So very much a team approach. So many times there is a number of individuals on a team, so there may be a wealth advisor. There's always a relationship manager. That may be a wealth advisor or someone else very close to the client that really brings the team together. And many times there's a trust officer or a fiduciary specialist, investment manager or an investment strategist, which is really the portfolio manager. There may also be a financial advisor or in some cases a banker as well. So it's really is a team approach where the relationship manager really, as I mentioned, kind of quarterbacks the team, and then there's a number of different specialists on the team as well that are really there to provide a different type of expertise in order to best outline and ultimately help clients achieve their financial goals and needs. So the other divisions here, just for perspective, we did include them here on this slide. So this is really encompasses all of WIM, Wealth and Investment Management. So it's the 6 different divisions: Abbot Downing, Wealth Management, the private bank that we both kind of talked about. The other 4 divisions are Wells Fargo Advisors. So this would be more of your client brokerage. Wells is one of the biggest brokerages out there. I think there's about 15,000 financial advisors around the country, so it's a pretty big unit. Institutional, retirement, and trust, so it's more retirement plans. Wells Fargo Asset Management, so that's investment solutions, things like mutual funds, different investment products for clients. And then lastly, Wells Fargo Investment Institute, which is more of our research arm. So they do a lot of the strategy, things like manager research, asset allocation, those types of higher level strategic investment capabilities that comes out of the Wells Fargo Investment Institute. So yeah. Any questions so far?
Maybe we'll get into it, but just wondering how, so that the Abbot Downing piece and the private wealth piece, I mean, is there much interaction between investment strategists, between those two, or are they unique enough where you're going to be focused, it's going to be more client-specific and more specific to what you're working on?
Yeah, I would say that there's some interaction. They are different. They do operate independently.
Right.
They both fall under the wealth and investment management segment at Wells, but they do operate independently. There's times when accounts when clients may I think transition from one to the other, just depending on needs. And we can talk a little bit more about that maybe when we get some more, maybe talk a little bit more about the differences. And I know family dynamics is one of those differences, maybe in Abbot Downing versus wealth management, but.
Yeah, I definitely would echo that. There's certainly some similarities and overlap in approaches and communication, things of that nature, but I don't know, Abbot Downing definitely thinks of itself as an independent entity and sort of serving a very unique client set. And so, yeah, I would say we think about things fairly independently.
Yeah.
So, jump ahead to responsibilities in the role.
Sure.
So this first one, fiduciary responsibility, we have a legal responsibility to act in the client's best interest at all times. But more importantly, we put this one first because, I mean, clients' needs and interests should be at the center of everything that you do, whether you're trading an account, creating portfolio strategy, researching, doing your risk and compliance. It's important to always keep your clients and their needs top of mind and not get distracted by anything else. So that's extremely important. Those of you studying for CFA ethics, you'll see it in level 1, you'll see it again in level 2, you'll see it again in level 3. That's how important it is. So it'll probably come up again here in this slide, but it really is critical. So
yeah. So I guess as an investment manager, really your primary duty is to be that primary contact for the client in pretty much all investment-related activities. So I'll kind of go into that a little bit more detail. But so say we're first meeting with the client. Typically, you're doing a discovery process. You're helping a client, helping uncover what their needs are, what their goals are. For those that have taken level 3 of the CFA, you get into the investment policy statements. So you're meeting with a client, help create this investment policy statement, right? Which is gets into the return objectives, the risk tolerance, time horizon, tax, liquidity needs, those types of things. Helping outline that in an investment policy statement, which then becomes really the roadmap for how you're going to manage the account going forward. Also a part of the investment policy statement typically is an investment objective. So different firms do this differently. At Wells Fargo, we have 9 different investment objectives, ranging all the way from a income portfolio, which is typically mostly a bond portfolio, to an aggressive growth or equity portfolio. So once that's in place, as an investment manager, so you have the investment policy in place. The next discussion is then how are we going to put the plan in place? Meaning, what kind of investment solutions are we going to use in order to get that targeted allocation? So then we're having a discussion about different funds, so you may be using bonds, individual bonds, municipal bonds, taxable bonds, individual stocks, ETFs, funds. So then it becomes a discussion with the client about what are the client's preferences, what are the best way to arrive at that target allocation. So that's really the second piece is getting that investment portfolio in place, and And then lastly is continuing to manage and continuing to rebalance the portfolio depending on the continual needs of the client. So, and that's the key piece. And then it starts to move into more of the relationship side of the experience as well. So, and I'll let Jacob go into a little bit more.
Yeah, I just did one thing that was, just piggybacking on what you said, one thing that was sort of I learned quickly when I started at Abbot Downing is just the importance of communication with your clients, both at the outset and just continuously. These clients are not static entities. They're very dynamic, and it's important that at the like your best chance at designing a portfolio that they're going to be happy with is if you learn as much as you can about them at the outset and are staying up to speed with their goals and their needs. And so that's really a critical component. And our process is very similar. We have our own models that we have, but we frequently will branch out and customize from that based on client needs. Unique situation comes up, but like some of the things we're trying to tease out when we're setting that initial investment policy, and as I said, Chris alluded to, it's a big level 3 thing on the CFA program, but their risk objectives, their long-term financial goals, their return objectives and their risk, both of those kind of go hand in hand. You can't really have they're intimately tied together, and if there's a discord there in the client's understanding, it's something to try to rectify at the outset. You're thinking about time horizons. That's a big one for us because oftentimes we're working with multi-generational families. The time horizons are very long. They can be 10 years, 20 years, 30 years, multiple generations, and so that has an impact on how we invest accounts in those situations. We are able, not only with the level of wealth we're dealing with, but with those time horizons, to get into more private investments, all kinds of private investments, private debt, private real estate, private commodities, timber on the real asset side. On the alternative side, we get into lots of different private equity funds of different stages, venture, and also just a number of very unique funds. I don't know, they're probably proprietary to say, but like just unique private investments that with really some of the world's most elite managers. And so that I guess that's sort of definitely a big differentiator when we're building out portfolios, is the presence and the magnitude of the presence of the private investments and whatnot. But yeah, a lot of the process is very similar. Yeah, once the portfolio is established, you're managing it, you're following it, you're trying to keep it appropriately close to its targets, and we get more into the client service side, which I touched on the communication, but you have to then present the performance. So we meet with our clients usually on a quarterly basis, or sometimes semi-annually, and we're certainly tasked with building those performance presentations. We typically provide lots of market overview on the various asset classes, lots of information about their holdings and performance, and we slice and dice it a number of ways so they can understand. Our clients often will have custom reporting requests and needs, and so oftentimes we're building out custom spreadsheets or files or presentation pages to meet their needs, whatever those may be. And then a key component of that is, as you walk into a meeting, you need to be prepared to explain what's occurred. So there's you should always be on top of your portfolios and their performance, but especially when you're going into a review, you do a deep dive on the portfolio attribution, and so you can explain to the client at the whole level, did we outperform, did we not, why, and then breaking it down as you get into talk about the various asset classes, maybe highlighting, everyone has their own style, but highlighting certain managers that did well, other managers that didn't, and really being able to explain what happened and why, and being prepared to field any and all questions they might have. So there's definitely a big thinking on your feet component that's involved. So.
Yeah, I know I have many scheduled meetings throughout the week, but then also many times I'll get I'll get many calls from clients with ad hoc requests about their portfolio, about changes that they see impacting their plan, and then it becomes a discussion about how do we change the strategy? What changes do we need to put in place in order to make that impact? And then lastly, of course, a big component of this role, client relationship building, and then also new business development and new client acquisition as well. So I would say the thing that I like about this role really is that it's investment related, and it's also communication and relationship building. So which I find nice, because you get to use your analytical skills and your research capabilities, and then you get to go out and explain those to clients. So you get to see both sides. So
Yeah, without a doubt.
so our next slide here. So this talks a little bit about opportunities and challenges as we see this role. The first one there, you definitely get to interact with a lot of smart, interesting partners and clients. I like to think that we get to work with a lot of the bank's best clients, and I mean that not only in a financial, kind of the financial impact to the bank, but also you're working with a lot of clients that do have some complex needs, and you get to advise and help those clients achieve those goals. So it's very rewarding that way. If you think about it, there's maybe a few industries where you really get to have such an impact on a client's well-being over time. So there's a lot of responsibility in that, but it's also pretty rewarding. So.
Yeah, well, no, without a doubt. I mean, the people I work with at Abbot Downing, I mean, extremely educated, and there's so many have just so much experience in the industry, and they come from a variety of backgrounds. Some have worked international in various capacities. Some have come from a focus in a particular asset class, or have managed an individual stocks, like a specific stock strategy before. And so just being able to work in the same environment with those individuals and network with them and learn from their experience is really fantastic, and makes the job a lot of fun. And certainly, as Chris alluded to, it's the people side of the business is fun. There are great clients, and certainly the Abbot Downing clients have some fascinating stories. Typically, you don't get to that level of wealth without an interesting story. I would say, if I had to say what the most common source of wealth is typically they started and or owned their own business that was quite successful, and they've sold for a substantial amount of money. So just being able to hear their stories and experiences and interact with them is selfishly just very interesting, and they're really interesting people to work with, certainly. So. And I don't know, I guess I would echo that piece, that there is something rewarding about sort of the two sides of the business, as pretty much exactly as you said, Chris. You get to dive deep, and you do analysis, do research, use, sort of be intellectual, use your brain power to, construct good portfolios, and then you get to help real people. We have clients that are, quite wealthy. Some of them are extremely sophisticated, but others, might not be as sophisticated. And the markets are challenging, as we know, and it can be an intimidating world. So to be able to work hard and deliver a great product at any level of wealth that's going to help people meet their financial goals, help people meet financial goals for multiple generations, for their grandchildren. Provide meaningful advice, really be a trusted advisor who they turn to when things get rocky and when, markets correct and things like that. That's a good feeling to be able to provide that level of service and guide them in a direction to meet their goals. So that's a fulfilling feeling about this job, certainly.
Yeah. Yeah, it's definitely a job where if you have a strong interest in investments, it's really, I think, a very good industry to be in, because like I say, you get that analytical side of the business, and then you get to take those ideas and you get to talk to clients and help clients achieve their goals using a lot of those types of that analytical work that you've done. So.
Just one other thing, and sort of like the variety of the job. We say every day is different, and there's a wide range of products and strategies. I mean, that's one of the things I like the most. You work with clients. You also do portfolio management. I focus on all four major asset classes. I get to think about equities and fixed income and real assets, and also I get to work with private investments. And as I said, some of the best managers around, and that's fantastic. There's so much to learn from there. We have an internal stock strategy, a concentrated stock portfolio called the Global 25. I work closely with that team, and so I get a flavor in my role of getting to work getting to work in an individual stock strategy. We have a portfolio construction team that's really focused on the analytical side, risk metrics and things like that. I get to work with that team. So as we were talking about earlier, you get your hands in a little bit of everything, and that's something I really liked. And you get exposure to all that, and then maybe down the road, you can decide, there's something I really am interested in fixed income, and maybe you want to, get more involved in something in that capacity. But that's one of the things I like the most. My days are very different. I get to be involved and work on very different parts of the business, and it definitely keeps me engaged. And I learn a lot. So, Challenges?
Yeah.
You want to just handle all of that?
What was it?
You want to just handle that whole section?
So challenges. So it is a business where relationships are really important, right? I mean, we're working with a lot of individuals. So for those that have taken the CFA program, behavioral finance too becomes a big component of your day-to-day. So things like inherited positions, concentrations, and low basis stock, and those types of things. They become big discussion points over time. There are many demands on your time from clients and partners, of course, as the markets continually change and your clients' needs and goals continually change. You do get a lot of requests from clients for information, ad hoc, and scheduled meetings over time. And each client really is unique. Just as I've mentioned, I mean, clients' goals are very different. You may be working with someone in their 20s who's really just starting out and maybe inherited some money, and they want to put a plan in place for their future, buy a house down the road, help put their kids through college. That's a different scenario than someone who's getting close to retirement, who's now starting to think, how am I going to live? How am I going to generate the income to live off of in retirement? And I think in Abbot Downing, there's a number of other scenarios as well where you're working with different profiles of clients who have much different goals and needs.
Certainly. I mean, within an individual family, take a multi-generational family, generally there's one person or a couple of people who generated that wealth and are passing that on, and so you can have a couple of accounts that are massive, $50, $60, $70 million, for example, and then you might also be managing a grandkid's UTMA account that has $30,000 in it right now, and those are equally important, equally important to the client, but a drastically different investment approach, and you can sort of imagine that out then, just clients of all sorts of different ages and stations and even levels of wealth within the family, and so you definitely need to treat sort of each account and each client appropriately given their set of circumstances, their needs, and the level of wealth they're at and what their goals are. So we definitely, that's the most common thing I would say in sort of terms of different clients, is just within the families. there's just, it can be a lot. You have accounts that are very different in how you treat them, which is interesting. We definitely have to be prepared to communicate tough topics sometimes. I mean, that's never fun. I mean, sometimes, when markets are going through struggles, that's never a particularly fun time. Just when they're down sort of across the board market corrections, clients can get concerned and whatnot, and those can be more challenging conversations. Ultimately, there's going to be times where you're going to underperform as well, and you have to go into a client meeting and the portfolio has underperformed the benchmark, and you need to be prepared to talk about that and explain what happened and have a plan for what's going forward. If somehow usually it's just things fluctuate and you've taken an active bet that it just isn't favorable at this time, but you still have conviction in it, and you believe it'll come back, or in another probably rarer situation you may need to. The thesis may have been violated, and you may need to, change approaches or things like that. But those conversations, are probably tough.
Yeah.
You only outperform though, Chris, so it's not a problem for you.
Well, and that's where it goes back to clients' needs are different. You have some clients who maybe they are looking at relative performance versus a benchmark, but you might also have pretty wealthy clients who are just looking for absolute performance as well. So, and that's where it gets back to that relationship building. And the earlier you can get to know the client and build that relationship and understand what makes those clients tick, the easier your job gets over time. So.
It harkens back to the communication point I was stressing earlier, but it's very important to set appropriate expectations for your clients and have them tracking the right things. If they have a well-diversified portfolio, but they're comparing themselves in their heads to the S&P 500, there's a disconnect there. And I definitely see people from the behavioral side get caught up comparing themselves to friends or sort of other benchmarks that maybe aren't appropriate, and so effective, as I said, guidance and setting expectations is certainly very, very important. We just had a request come in from a client this week that I've sort of been working on crafting some slides for and a narrative to go along with it, where the client has felt that his portfolio is well diversified, so he understands that it's going to lag on the S&P 500 on the upside, but he's worried he's capturing the full downside, and so I've been working on analysis to show this individual that actually he's right about the upside part, but the downside part. His portfolio is performing across the board as we would expect, and so even you're sort of in this constant place, and and we're going to have to probably reframe and keep things in mind about what benchmarks to be looking at and things of that nature, and these are the types of things that just sort of come up all the time.
Yeah. It's of course it's a very competitive industry. It's a large industry, and I think it's a growing industry. It's as we talked about, you really get to help clients meet their needs, and it's if you think about it, everybody out there should have a plan for how they're gonna for their financial future, right? So it's a very large industry that way, but it is competitive. So you always need to show how you're adding value. Of course, when you're working with markets, you're always working with incomplete information, right? So those that thrive in that type of environment, this job I think is well suited to that. Regulatory and compliance is becoming a bigger and bigger part of the industry for probably good reasons, well-intentioned reasons, but it is becoming a bigger part of our job on a day-to-day basis as well. So things like the investment policy statement, we need a signed document from a client every couple years. So we get that to make sure that we've confirmed that the right plan is in place for that client. So those types of things, doing annual reviews, so certifying that yes, all these specific situations are in line with the client's needs. So.
Yeah, no, I'm glad you touched on that because I don't think it's important stuff, but I don't think it's and either of our probably favorite part of the job and whatnot. But it would be remiss to skip over it as I said, we definitely fairly heavily regulated, and there's lots of work that needs to be done fairly consistently to just sort of keep up from a paperwork and review perspective and things like that. So.
Yeah. And that's also where things like concentrated assets come into place, and making sure you're having that discussion with a client who holds 50% of their portfolio in an individual stock, who just has a really outsized position in one stock. Having those discussions with clients and having a plan in place for how are we going to manage this risk. Another opportunity and challenge we have in here. Every day really is different in this job. You may go in the morning and think, geez, I'm going to rebalance all my accounts today. Well, and then you get a call from one of your largest clients who wants a detailed analysis on the last month's performance, which can completely throw your to-do list to the side. So every day truly is different, which it is an opportunity and it's a challenge at times, but it is what makes the business fun and exciting, I think.
Oh yeah, you definitely have to be able to dance a little bit, and especially like in meetings too. I mean, a client you work very hard to stay very well informed on certainly the accounts and the managers and economic and market news, but I mean, you can't be prepared for everything, and so within a meeting or on the phone, you need to be prepared for kind of expect the unexpected and be able to answer all client questions, and I don't know. I mean, if it's a particularly difficult one, there's nothing wrong with getting back to them on the subject. It's far better than giving a poor answer, But definitely, every day is quite different.
Any other questions so far?
I was wondering how these are high net worth clients, right? So how are their needs in terms of returns and risks different from an average investor?
Yeah.
Are they okay with? I'm assuming that they'd be okay with more risk for higher return because they have enough money to take chance on.
Yeah, I think there's two sides to that, right? You only need to be rich once, right? Once you've generated that kind of wealth, then it becomes preserving that wealth.
Oh, okay.
So that's part of it. But then you're right. Once you get that wealth, then you can afford to take the risk too to generate outsized returns. So that's when it gets into, I think, client personality and what are they really trying to accomplish. And that's where you're talking, and Jacob can talk a little bit more about this too, but working with what do they want their money to do for them? Is it generational? Is it ultimately going to be passed on? Is it going to go to charity? Is it those types of discussions? So it's definitely not a one. It's hard to put every client into a certain bucket because every client's going to be different. And a lot of times it's going to come down to the personality of the client. So that's where you're doing a risk profile. We have questionnaires and stuff that we can use to get a little bit into that, but really I think the best way I've found is really just having the discussion with the client. Of course, the client's past experience is going to play a big part in that too. What are they comfortable with? Are they comfortable with an all-equity portfolio? Because not every client wants to go through a 2008 where they lose 40% of their portfolio. Our biggest job probably is to keep those clients invested through those times. But, geez, we know clients who sold out in 08 and never got back in. So it's really we're there to help clients through those tough times. But putting the right plan in place from the beginning, I think, is pretty important.
And so do you invest their money mostly in public traded stocks, or is it also that you find some private investments that, the market is not aware of, but a private company who knows that somebody who has that much money can invest in them. Is that also what you guys do, or only publicly traded stocks?
So to get in a little bit more about our philosophy, so we 4 asset classes, typically, stocks, bonds, real assets, and alternative strategies. So alternative strategies, that's when you're going to get into private equity, private debt, and those types of things. I would say from a regulatory perspective, you need to have a certain level of wealth in order to get into private equity and those illiquid type of investments. That, and just combined with the fact that you don't want to tie a large percentage of your wealth into a private illiquid investment with a 10-year time horizon.
Right.
So the larger the account size, the more you're starting to use alternatives. It's probably in Abbot Downing, the percentages of their portfolios, the higher they have higher allocations to alternative investments because of they have longer term time horizons when you start to get into multifamily generational wealth.
Some people even if they have the capacity, they don't want to tie up that type of money. They're perfectly happy, even though they could have all kinds of private investments and it would be appropriate and probably over my time might generate outside a better return potentially in the long run. They're comfortable staying with all liquid investments. It really depends on the preferences. This is sort of getting into the weeds, but private investments have a much more of a complex tax situation. So they generate K1s, and so the client might not want to deal with all that tax-related and accounting stuff. Like that's happened before. We these private investments generate a K1, and every single one of them, if you have 10 or 20 of them, that's a lot of K1s, and most of the clients have their own accountants outside that take care of them for it. But in certain circumstances, we just had a fund that we're trying to commit capital to right now that has we've learned a particularly outlandish K1 that is hundreds of pages long. And that's actually turned some people off, and they're like, the client and their outside investments, their outside staff, their accountant is like, they're not going to be comfortable with that. And so I don't know, those sort of things come into play sometimes too. But what we'd like to do, and certainly the investment philosophy we pitch is if it's appropriate from a time horizon perspective, and we like to get the clients into the private investments just because our analysis shows that they're going to generate the outsized return over time because of that illiquidity premium and whatnot. So that's definitely a focus if the client is able and willing and whatnot. So.
Yeah. So those alternatives come with additional tax complexity, and then also you're locked up for a longer period of time, and not every client wants that. I have a client who has a total net worth of probably $15 million, but he wants to do his taxes in early February every year, so he's not a good candidate for a illiquid private equity fund that's going to issue their K1 in the summer sometime. So.
But the majority of the portfolio is still publicly traded securities, stocks and bonds and things of that nature, for taxable accounts. So we're definitely given our clients, top tax bracket, they're pretty sensitive. So we try to focus on municipal fixed income in accounts that are taxable and whatnot. So we try to be very conscious of taxation and things like that for the clients, because with the amount of money they have in the tax bracket, you can generate an ugly tax bill quickly. So it's very important to be conscious of that, because I don't think they would react too kindly to that. So.
Any other questions before we move?
I'm sorry, I'll have to leave. I have an interview right now, but I'll connect with you guys on LinkedIn.
Okay.
Sounds good.
Thanks for coming over.
Yeah, thanks for stopping in.
Give us some idea, what's the size of the investment team that you work on, and sort of I assume you guys don't work on every single client, so how does that, do you work with a certain dedicated advisory team or a certain type of client, or how does that all play out?
Well, so in the wealth management group, I would say that we have 4 different offices around the Twin Cities area, and you don't have a dedicated team, but you kind of over time you work more and more with those that you kind of just gravitate towards working with certain people.
Is there a certain,
but-
like, sort of lead advisor then that you'd
Yeah.
be working with, and you'd have the investment piece of it? Is that kind of how?
Yeah, so typically there's a relationship manager.
Sure.
So that might be a wealth advisor, or it could be a fiduciary advisory specialist, or a trust officer, or a financial advisor. It really depends on the client's experience with that individual. Anybody could be a relationship manager. It's just there's an additional level of responsibility in that role because you really are bringing the team together. So I guess it kind of depends.
Yeah, I mean, it's definitely regional for us. You know, we have the 11 offices around the country, and the relationship managers are the ones primarily responsible for sourcing the business, and so they're leveraging contacts and relationships, generally speaking, you know, in the geographic region. And when the business is ultimately won, the region typically has its own teams, and so it would probably go to the regional chief investment officer of that particular region, and he or she would sort of decide, you know, which investment strategist is going to work with a particular family. Depends on capacity, depends on fit, and things like that.
Personality.
Personality is definitely. And so after that, I mean, a lot of the regions, some regions and offices are big enough where there are bankers and planners and things like that right there, and house others might have to connect with bankers and planners that sit in other offices. But for us, that's typically how it sort of comes together.
Does that answer your question?
Yeah.
Okay. We did have just a few more here. I think some of this is we've kind of covered, but these are really just some of the key skills that we've found in this role to be most important. Of course, interpersonal communication skills we've covered. Combining that with the investment knowledge, I think, really is essential.
No, something that came up when I was thinking about you guys just starting level 1 of the CFA program. It made me think about when I was at Ameriprise, one of my networking meetings. That's when I learned about the program, you know, studied for level 1, passed level 1, and it was sort of, you know, once I had that under my belt when I started looking, you know, I learned from that experience, and I had that having passed level 1 under my belt as I sort of went to look for other roles. And I feel like, I don't know, you guys are sort of in similar positions, and it was definitely helpful, you know, both in terms of what I learned and helping me figure out where I wanted to go, and also for people, you know, prospective employers. It was good. So I thought I'd throw my vote of confidence to your process and where you're at. It reminds me of my own. It seems like a good approach, and the CFA program definitely has strong standing in the investment community. So.
Any other questions you guys have? I know we've kind of covered some of this, so I want to make sure we go on with some of the questions.
I do have a couple of questions. So it does sound like, you know, when it becomes a strategist, particular roles you guys are in, with working with, you know, coming up or constructing a portfolio, how closely you guys work with the WFII, which is the Investment Institute guy, really bring the additional value to the customer, to clients you guys have, because, you know, constructing one that get every single you know, variation that consumer or like clients want is very hard to do with one person particularly, or, you know, a group, a small one.
Yeah. So we definitely leverage the best thinking of the Wells Fargo Investment Institute. We talked a little bit about it, but that's really the research arm. So they do a lot of the high-level strategy and the allocation. They do manager research, those types of things. So there's definitely the best thinking of the firm is within the realm of Wells Fargo Investment Institute, and then our job is really to take that best thinking and apply it to the client. So there's not, and that's really where we tailor that thinking to the client. Depending on the needs, it's just, not every client is going to fit into a perfect box, and that's where we take that thinking, we discuss that with the client, and put that in place. So things like tactical adjustments because of needs and wants of the client, tax considerations, liquidity, we may not be able to implement, may not always be able to implement every strategy change at that point in time, just because of constraints that are present.
Yeah, I mean, we definitely leverage the rest of Wells Fargo consistently. I mean, we get research and output from them all the time. I read Institute output and Wells Fargo different WIM research reports probably on a daily basis. They're putting out really good content, and it's fantastic that we get free access to that. The partnership is also huge, just from a business generation perspective. I don't know, sourcing clients at that level of wealth, it's tough to, you don't just sort of just walk around and typically run into them. Typically you're able to leverage the power of the bank, and the clients have a previous relationship with the bank, either, through their, they do their business banking through Wells Fargo, or they're selling the company and they're going to, use the investment banking group. And so we definitely leverage the rest of the bank, and the relationship managers do, to source a lot of clients, and it's, we definitely leverage the power of the institution a lot at Abbot Downing for those purposes. But I don't know, I mean, like in terms of, like capital markets assumptions and things like that, I mean, WIM puts out these things called capital market assumptions every year, and they do extensive research, and they sort of release this big report that it sort of like lays out for sort of the coming year what their expectations are for inflation and pretty much all sorts of indices and markets and investments and things like that, and it's based on these sort of the best thinking, and we're often able to Abbot Downing certainly takes that, and our portfolio construction team takes that, adjusts that based on our thinking, and then because of those assumptions, there's risk return associated with that, and you're able to, once you have these assumptions laid out, well, then you sort of have the universe of investments and what you expect them to do from a risk return perspective. You can sort of pull in their characteristics, and then you can do sort of the analytical component and see how things fit together and fit together in the best way. And so in that sense, we definitely leverage the institute for the capital market assumptions and things like that as well.
So they put out like the strategic asset allocation, which I think is a level 3 topic.
Yeah.
So that strategic asset allocation, that's going to be your longer term allocation, right? Your 3 to 5 year allocation. You're going to average out over time to have a certain level of allocation between stocks, bonds, real assets, and alternative strategies. But on a tactical basis, maybe our opinion is stocks are going to outperform other asset classes. So on a long term, you have a strategic allocation, but you're never going to be there exact, right? It's not precise, and you're going to make more tactical calls, more 1 to 2 year tactical positioning, depending on your market outlook. So, and those are things that the Wells Fargo Investment Institute assists us with as well in our role.
Thank you.
Yep.
So yeah, definitely take bits and pieces, bits and pieces, but it's super helpful to have.
Yeah,
the
but again, we
research
have a
and what they do.
goals-based process where we're really tailoring our best advice to the client. So it's not a one-size-fit-all approach, And that's where the relationship building really comes into play in the communication with the client. So, and that's where it's really vitally important that you have that investment knowledge, but also that relationship building ability to put them all together. So.
And does your job combine both speculative and conservative strategy? And do you guys feel like you learn a lot kind of bouncing those off of each other between different portfolios?
Yeah, I would say that kind of, so the conservative and more aggressive, we would say more aggressive as opposed to more speculative. Just the more conservative portfolios, they're going to be more income-based, right? They're going to be more fixed income. Clients who just want to generate a level of income. That's much different than that more aggressive portfolio where they're really looking for growth. Those growth portfolios, they're going to be primarily stock portfolios and private equity and those types of things that are really looking for outsized returns.
Yeah, I think that's a big difference, not only the income component, but it's sort of like the volatility of the portfolio. What kind of, what kind of ride is the client going to experience? With a more conservative portfolio, fixed income portfolio, that portfolio is not going to fluctuate as much, even during the bad times. But if you have a more aggressive portfolio, while in the long run you would expect to earn, an increased return, you are likely to have some volatile periods where the portfolio does fantastic and some periods where the portfolio really does poorly. And that comes with it. It's expected, but you have to be able to stomach that. It can be. And it can be a shock sometimes to clients to turn around in one quarter you had a certain amount of money and it could be down 10% or something if you're in a particular aggressive, and it's something you have to feel out with the client if they're going to be aggressive. Sometimes they might want to get somewhere, but if they can't stomach the ride, it might not be appropriate if it's going to cause too much stress or things. So you're trying to feel that out as well.
Did that answer your question?
And I guess, does that help you learn, I guess, for future periods, like how to continue meeting low, kind of conservative returns versus aggressive returns? Does knowing how to create conservative returns help you create aggressive returns at the same time, knowing the markets and strategy a little bit?
Yeah, I would say that it's very client specific. Those clients who are more conservative, they typically are in a conservative portfolio for the long term. Our philosophy is not one in which you're going to take a conservative client and then in certain periods of time, even if we're the most bullish, we're not going to take that client and put them in an aggressive portfolio. So we're really planning for the long term, we want our clients to meet their needs over the long term and making those market timing calls in order to switch the allocation like that. It's typically that's not what we do at Wells Fargo. Does that kind of make sense?
Yeah, you definitely long-term focus, but yeah, as people go along, sometimes they do switch strategies. Sometimes, people they think they have a certain level of risk tolerance, and then they go through a volatile period, and they realize that they don't, and that's when we might be looking to construct a new IPS, and we've said we're set up pretty aggressively, and we're going to dial that back a bit. We're going to dial that back to understand that's likely to, reduce your overall level of return in the long run, but we're going to bring down your volatility, maybe increase the income a little bit as needed, and we do that with make a new IPS for the portfolio or something.
Yeah,
those are the switches I would see. You don't typically see something going from super conservative to extremely aggressive. And we try to avoid market timing since we feel it's a very inexact science, even and something the best probably rarely get right with enough frequency to validate the endeavor, I guess.
Clients' needs are going to change, and that's where the strategy might change too. So typically you're earlier in your career, you're looking to grow your assets because over time, and once you've reached a level of growth, then you're looking to dial it back a bit. Just generically speaking. So your goals are going to change, and then that's why we're always meeting with clients and always having the discussion to make sure that the plan in place is the most appropriate plan.
Yeah, Abbot Downing, like a lot of the clients have so much money that like, having enough money for retirement or putting kids through college, that might not be so much a question or a goal, but clients very much have their own goals and desires and personalities. I can think of a couple of our largest clients who are very aggressive. They want to grow that portfolio. They've got tons of money, and so we're invested very aggressively. We leveraged a lot of private investments and things like that. And we have other clients who are very nervous about markets, and that they might have a significant amount of wealth, but just the way their personality is and the way they sort of their outlook, we have a much more conservative approach. And so even when the various needs aren't there, people still very much have their preferences and personalities that can, drive how you set things up. It's interesting to see. That's why you got to focus. You got to take care of the needs. The needs first, but the personality piece is just because someone can do it doesn't mean you should throw them into something super aggressive. You got to listen, because at the end of the day, it's their money, and they're hiring you, and they can fire you, and so you need to listen to them. So
I would say you guys achieved your objective of turning this into a marvelous conversation, which I am now going to cut short. So, Chris, Jacob, thank you very much. Really appreciate it.